Hello, today I'm going to discuss about paper 22 of May-June 2015, number 3. Akhtar Hussain is a trader. He maintains a full set of accounting records. His financial year ends on 31st of March. Akhtar Hussain provided the following information at 31st of March 2015. The inventory was valued at 4,150. This will represent your inventory at the end. Because it's dated at 31st of March 2015. $54 owed by XY Limited is to be written off as bad debts. You have a bad debts. Provision for the full debts is to be reduced to 1010. Reduce to, not by, but to. You have to find the difference, or the increasing or the decreasing value of the provision. Decreasing value is question mark. A machine was sold on 1st of March. The amount received was recorded, but no other entries were made. The machine originally cost for $3,000 and had been depreciated by $2,250. This is a disposal. Therefore, we need to find profit or loss on the disposal. Number 5, the remaining machine cost $5,000 is to be depreciated at 25% per annum using straight line method. You are required to prepare accounts, and one of the accounts is inventory account. To do inventory account, you have to have two informations of opening inventory and closing inventory. In this case, you already given with the informations of opening inventory, because it said here in the inventory account that you have a balance at the very beginning, 1st of April 2014, for 3560. And then you are also given with inventory at the end for 150. Now, to the inventory account, it's really simple. You have to put IS in the credit side and IS in the debit side, and then balance CD in the credit side. Simple as that. First, we have to close this balance PD to income statement, because opening inventory will be transferred to income statement. Date, the end of accounting period, which is March 31st of 2015. You put IS, and then the amount is the same like BD, 3560. And then you go to the debit side, 2015, March 31, another IS, but this is at closing. So your closing is this. So it's 4150. And then you close with balance CD, 2015. Oh, no need to put the year, because it is still in 2015. So you put balance CD like this, and then 4150. Total would be $107.7. And then don't forget to carry it down to the next accounting period, still in 2015, April 1st. Balance BD 4150. 50. Done. And next, your bad debts account. First of all, you have the informations of balance, not balance. On January 10th, you have ABC stores, bad debts, and then informations about bad debts above is from number 2. It said that $54 owed by XY Limited is to be written off as bad debts. Is to be written off. So, another new bad debts at 31st of March. So you have to put it like this in the debit side. XY Limited 54 dated March 31. And then that's it, because bad debts is considered as expense and expense must be transferred to IS. So to close this account, you need to transfer it to income statement, not balance CD. 2015 March 31. Total to be transferred to income statement is 190. And then that's it. Provision for the full debts account. This provision for the full debts account will affect it if there is an increase or decrease in provision. The information about provision for the full debts is given in number 3. It said it is to be reduced to that means at the point of 1,010 right now, not by 2,000, not by 1,010. If it is using by, that means the amount given in the questions is the amount of increasing or decreasing value in the provision for the full debts. But if it say 2, that means you have to find the decreasing amount because this is the end balance. The end balance is 1,010. It is to be reduced. Now we calculate if you have a beginning balance of 110 and then you have ending balance is 1,010. So it is decreased by how much? It's 20. So it is decreased by $120. Provision for the full debts, if it is increased, it is increased in here. If it is decreased, it's decreased in credit side. Now, since it is decreased, so it would be posted to the debit side. How to record this? You have to put IS and the amount of the decreased amount. Date at the end of the accounting period of 2015, March 31. And then last one, you have to calculate balance CD. Your balance CD would be the same like your end balance, which is 1010, and then it is 1,130 and 1,130. Carried down to the next counting period, 2015, April 1st of balance BD, 1010. That's it. Next is provision for depreciation of machinery. Provision for depreciation of machinery will affect it or change. It is change if there are two transactions. The first one is depreciation for the year. The second one, if there is a disposal. Now we check on the questions given in number 5. You have a depreciation information. It said that the cost is 525% using straight line method, and depreciation, if it is using straight line method, the formula would be rate times with cost. Your rate is 25% and the cost is 5,000. It is equals to 1250. So this is your depreciation. Second one, disposal. On number 4, you have informations about disposal, and it said that a machine was sold on 1st of March. The amount received was recorded, but no other entries were made. The machine originally cost 3,000 and had been depreciated by 2,250. Had been depreciated has the same meaning like total depreciation or provision for depreciation. So you have provision of the disposed asset and you have a depreciation for the year. After you have the two, we continue to fill out this depreciation account. Depreciation for the year will be recorded in the credit side, but disposal will be recorded in the debit side. It will always be like that, because if there is a disposal, it will decreasing the provision for depreciation of the assets that you hold, because it is no longer on your hand, so you have to erase it from the book. Meanwhile, depreciation for the year will increasing provision for depreciation, because provision means accumulation. Accumulation also the same like total. So provision for depreciations of machinery is actually means that total depreciations that you have made up until now. So whenever there is a depreciation, new depreciation, it will increase the provision. So you already have depreciation for the year and it will be posted in the credit side, and you will record that in the details as IS. But the date is at the end of accounting period, which is March 31. Details will be IS, and then the amount of depreciation is 1,250. After depreciation done, and then disposal. Disposal in the debit side, date is 2015, and the date of the disposal transactions is at 1st of March. So we follow that. Instead of 31, we put 1st of March, the date of the disposal transaction. We put disposal, and then the amount is 2,250. Next, balance CD. Depreciation's done, disposal done, and then balance CD. Balance CD is at the end of accounting period, which is March 31, and the amount will be, total credit is 5,750, so the debit side must be 5,750 as well. Balance CD would be 3,500. And then don't forget to carry it down to the next accounting period, which is 2015 April 1. Balance BD of 3,500. Next is disposal account. In disposal account, you have to find 1, 2, 3, 4, 1, 2, 3, 4, 5. No, 1, 2, 3, 4. Except if it is exchange. If the disposed is exchanging the new asset with the old asset, that means you have 5 items that you need to be considered. If it is only a simple selling of old asset, you have to find 4 information. First is cost of disposed asset. Second, provision of the disposed asset. And then proceeds. Proceeds is the selling price. Last one, profit or loss on disposal. Cost of disposed asset would be in the debit side. Provision is in credit side. Proceeds is in credit side. Profit or loss, it depends. If it is profit, it will be in the debit side. If it is loss, it would be in the credit side. Okay, next. Proceeds always represent by bank. So, if there is an information about bank in the disposal of machinery account, it represents your proceeds. So, first information we already got, proceeds, and then provision of disposed asset and cost of disposed asset. I believe there is an information above on number 4 that the cost is 3,000 and provision is 2,250. So I go back to the disposal account, and then on 2015 March 1st, I'm gonna put machinery at cost of 3,000, and then still in the same date we have provision of 2,250. Remember the above informations, yeah? This one 3,000 and 2,250. So 1, 2, 3, 4. So if we look on the difference between debit and credit, your your debit side is higher than credit side. That means you have a balance at the end in the credit side, which means you have a loss. So how to post this loss? Because loss is considered as your expense in the income statement, so it has to be transferred to income statement. So you have to put IS instead of loss on disposal. Okay, and the difference is 200, and the total is 3,000. This one is 3,000 as well, and the date is at the end of the accounting period, which is March 31st, not the date of the disposal. And then done. Next is the account of drawings. The accounts of drawings is really simple. Whenever there is a drawings, you must always have to close it to capital. Close it to capital. Like it's always be like that. So if you have a drawings on February 1st, 1000, so you close it to capital, date at the end, March 31, and then 1000. Done. That's it. Next, on 30th of March 2015, Akhtar Hussein received an invoice for 9,360 from PJ Autos Limited. This included 360 for repairs to a motor vehicle. The remainder was the cost of a new motor vehicle. Now, we call this as we make a journal entry, but we have to differentiate between which item goes to which categories. For example, if the invoice given from PJ Autos Limited is 9,360 and it is consists of 364 repairs and the remainder was the cost of a new motor vehicle, you have to make two different accounts, even though it is the same motor vehicle that we are talking about. But first, 360 is for repairs, and repairs will always be treated as an expense. Meanwhile, new motor vehicle is considered as non-current assets. So, how to make a journal entry of that? First, you have to put motor vehicle, because your motor vehicle is increased, you purchase new, and then motor vehicle repairs. So this represent asset, this represent expense. If your repairs is 360, that means you purchase the motor vehicle is only for 3,000. So that you have a trade payables to PJ Autos Limited of, I'm sorry, it's supposed to be 9,000, so it's 9,360. It said narrative is required, so you just have to inform this journal entry is what about. So you can say invoice, receive for purchasing new motor vehicle and paid and motor repairs. That's it. Done. Next, C. State the meaning of the following terms: capital expenditure and revenue expenditure. Capital expenditure is when the money is spent to purchase or acquiring acquiring new non-current asset. Meanwhile, revenue expenditure is money spent in the business on a day-to-day basis. Okay, so capital is to purchase non-current assets. Meanwhile, revenue expenditure is for day-to-day activities or basis. Last one. On 31st of March 2015, Akhtar Hussein discovered that an item of revenue expenditure had been recorded as capital expenditure. Revenue is expense. Capital expenditure is asset. If expense had been treated as an asset, so now your asset, your non-current asset, is overstated because you mistakenly added expenses as a capital expenditure, and then your expenses at that time would be understated. Effect of expenses understated, your profit now is overstated. Agree, yeah? Now, you are required to complete the table by putting a tick in the correct column to indicate the effect of this error. Effect of this error. You have to pay attention on the question. Sometimes the questions ask you the effect of correcting this error. Now, the effect of this error on the current assets. Because if you mistakenly read the questions, the answer will be the opposite. Yeah? Effect of this error to non-current and the profit. If the non-current assets on 31st of March 2015, based on our analysis in this box, yeah, this one is the first analysis, this is the second analysis, because you mistakenly put expenses into assets, so your asset now is overstated, so this is the answer. Second one, because your expense now is understated because you mistakenly put this expense into non-current assets, your expense is understated. That makes your profit also overstated, just like NCA. So the answer is overstated, both of them. Okay, that's the end of number 3. I will post another number in a short period of time. Thank you for watching.